Here's what's shaking the ground beneath global markets right now. Japan is stepping back from financing America's debt addiction. The yen is in free fall. Wall Street is watching nervously. Bond markets are flashing warning signals, and mortgage rates back home are climbing because of decisions made thousands of miles away in Tokyo. And the most fascinating twist, I've saved it for the very end. I spent years inside one of the biggest names in media, watching editors bend stories to fit whatever narrative served the powers that be. I got tired of the spin, walked away, and now I work for no one but you. I call it as I see it. No filters, no corporate overlords, just the truth laid bare. Before we dive deep into this unfolding crisis, do me a favor. Hit that like button, smash subscribe, and if you appreciate the work we do here, the hours spent fact-checking, cross-referencing sources, making sure you're not fed another round of fake news, consider sponsoring the channel. It's how we stay independent, how we keep digging when everyone else moves on to the next headline. Your support means everything. And trust me, you're going to want to stick around until the end, because what's coming is something most analysts are still missing. All right, let's unpack what's really happening with Japan, because this isn't just another story about foreign markets. This is about the foundations of American borrowing starting to crack. Recently, Japan's government approved a massive multi-billion-dollar stimulus package. On paper, it sounds like classic economic intervention: pump money into the economy, stabilize growth, keep things moving. But analysts immediately started waving red flags. They warned this package could destabilize not just Japan's financial system, but ours too. The reaction was swift and brutal. The yen, Japan's currency, tumbled to levels we haven't seen in nearly a year. Think about that for a second. A major global currency, one tied to the world's third largest economy, suddenly losing value at an alarming pace. Japan's finance officials scrambled, issuing verbal warnings about possible intervention. Finance Minister Satsuki Katayama stepped up and cautioned that Tokyo might have to step in to counter what she called volatile and speculative market moves. The yen jumped briefly after her comments, a little spike of hope. But here's the thing, that bounce, it did almost nothing to change the bigger, more dangerous picture unfolding beneath the surface. The yen is weak. Markets are nervous, and Japan's fiscal situation isn't just a domestic problem anymore, it's spiraling into a global crisis. Some economists, people like Peter Schiff, have gone as far as warning that Japan could inadvertently torpedo the US economy. Now, you might think that sounds dramatic, but when you look at the numbers, it's hard to dismiss. The yen has lost around 6% of its value since Prime Minister Shigeru Ishiba came into power. 6%. That's not a minor fluctuation, that's a currency in distress. And what's driving this decline? Aggressive spending policies. Japan is pouring money into stimulus, into infrastructure, into keeping its economy afloat. But there's a massive problem. Japan's fiscal outlook is worsening, and at the same time, there's mounting pressure on the Bank of Japan to maintain ultra-loose monetary policy. Translation? More spending, more debt, but no tightening in sight, no raising of interest rates to cool things down. It's a dangerous mismatch, and markets can smell it. Here's where things get even more intriguing. Something very rare and very unsettling is happening. Japanese government bonds and the yen are falling at the same time. Now, if you're not a markets person, let me explain why that's a big deal. Normally, when a currency weakens, investors might still trust the government's bonds. But when both are falling together, that signals two things: capital flight, meaning money is leaving the country, and deep market distrust. Investors are losing faith. Some analysts are drawing comparisons to the UK's bond meltdown in 2022. Remember that chaos? Unfunded tax cuts triggered a collapse in the gilts market, Britain's government bonds. It was a mess, and it nearly brought down the financial system. But here's the twist with Japan. Its choices don't just affect Japan. They carry far heavier global consequences, because for decades, Japan has been America's financial anchor. Let me paint you the picture. For years, Japan has been buying more US Treasury debt than any other country in the world. At its peak, Japan held $1.2 trillion with a T in US bonds. Think about what that means. Japan was effectively subsidizing America's spending habits, keeping US mortgage rates low, keeping credit cheap, making it easier for the government to borrow and spend without immediate consequences. But those days? They're ending. They're gone. Yields on Japanese bonds have surged to their highest levels in decades. 20-year yields have hit levels not seen since the 1990s. 30-year yields broke above 3.3%. And here's what most people miss. When yields rise at home, Japanese investors suddenly have a reason to keep their money in Japan instead of lending it to America. Why buy US Treasuries yielding less when you can get better returns domestically? It's simple math, and the United States does not want this shift to happen. So here's the question nobody in Washington wants to answer. Who's going to finance America's out-of-control government spending? Because the math that made Japan the world's biggest lender simply doesn't work anymore. Rising yields at home mean higher returns for Japanese investors domestically. Japan has an aging population that needs its savings kept close. New regulations are pushing major insurers to buy more Japanese ultra-long bonds. All of this points in one direction, away from US debt, and the numbers back it up. In the third quarter alone, Japanese investors sold nearly $62 billion in US Treasuries. $62 billion. That's not diversification, no matter what spin you hear from analysts trying to downplay it. That's an exit. That's Japan stepping back from a role it's played for 40 years. Wall Street is finally waking up to this reality. Analysts at Citigroup warned the shift could trigger what they called a global market Armageddon. Charles Schwab recently cautioned that repatriation of Japanese capital could push US yields even higher, and market veterans are saying this marks the end of an era, the end of America's 4-decade run of cheap borrowing, subsidized by foreign buyers. And guess what? You're already feeling the effects, whether you realize it or not. Mortgage rates that sat near 2.6% during the pandemic are now hovering close to 7%. 7. Credit card rates are at record highs. Car loan rates are rising. And as Japanese investors step back, buyers of US Treasuries are demanding higher yields to compensate for the risk. That raises borrowing costs for everyone, corporations, consumers, and the US government itself. This is the part nobody wants to confront, but it's happening right now. And here's the deeper layer that's about to get even more complicated. Japan's retreat isn't temporary. This isn't a blip, a couple of bad quarters that will smooth out. This is structural. Japan is aging rapidly. It's drowning in debt worth 235% of its GDP. Let that sink in. Its debt is more than double the size of its entire economy. Its bond market is breaking under the weight of endless stimulus. And its new prime minister is locked in an escalating economic confrontation with China. Tourism boycotts, seafood bans, military pressure, everything is on the table. At home, Japan needs money for defense, for stimulus, for currency support, for mounting debt service. But recent bond auctions have disappointed. The government is running out of options. If Japan raises interest rates to strengthen the yen, its debt costs explode because it has to pay more interest on all that borrowing. But if it doesn't raise rates, the yen keeps collapsing. Either path accelerates the unraveling of a system that once seemed rock solid and permanent. And then there's the carry trade, something I've covered before on this channel, but it's worth revisiting because it's critical to understanding what could happen next. The carry trade is a global financial machine built on borrowing cheap yen to buy higher yield assets elsewhere. US stocks, emerging market bonds, all kinds of investments. When the yen is stable, the carry trade fuels markets around the world. But when Japan's monetary world begins to wobble, when it starts to tumble, that entire trade can unwind in days, violently. We saw hints of this when the S&P 500 dropped 3% in a single day last year after a brief yen surge. With Japan now losing control of bond yields and currency stability, the risk of a violent carry trade reversal is rising again. If that happens, if the unwinding accelerates, you're looking at potential chaos across global markets. Stocks could plunge, credit could freeze, volatility could spike to levels we haven't seen in years. So what happens next? What should Americans be preparing for? First, understand this. We're entering a world where money is no longer cheap. Locking in fixed-rate debt becomes essential because adjustable rate loans are going to climb as Treasury yields rise. There's no way around it. If you have variable rate debt, now is the time to think seriously about refinancing into fixed rates before it gets worse. Analysts at BlackRock and Morgan Stanley are now recommending adding a variety of assets to portfolios. Real estate investment trusts, gold, commodities, alternative strategies. Diversification isn't just smart, it's necessary. Volatility is going to become the norm, not the exception. This isn't a transitory phase that smooths out in 6 months. This is the new reality. But here's where things get even more intriguing, and this is what I promised you at the beginning. Japan's fiscal crisis isn't just a story about another country's budget problems. It's a turning point in global finance, an inflection moment where the world's most reliable foreign creditor steps back, forcing the United States to compete for global capital at the worst possible time. Massive deficits, political division, geopolitical escalations, rising interest costs, all of it converging at once. In other words, the 40-year arrangement that allowed America to borrow cheaply while Japan picked up the tab is over. It's done. Japan is simply out of money, out of demographic strength, and likely out of illusions about its ability to keep playing this role. For a generation, America lived on borrowed time and borrowed money. That time is ending now. The transition is going to be turbulent, no question about it, but understanding what's happening and why is the first step in preparing for a world where the easy money era is finished and a new, more uncertain financial chapter has already begun. So here's what you need to take away from all of this. Japan is retreating from US debt markets, not by choice, but by necessity. The yen is weak and getting weaker. US borrowing costs are rising and will continue to rise. Mortgage rates, credit cards, car loans, all of it is getting more expensive. The carry trade poses a serious risk of violent unwinding, and the 40-year era of cheap American borrowing is over. These aren't predictions, these are realities unfolding right now. If you found this valuable, if you appreciate the fact that we're cutting through the noise and giving you the real picture, hit that like button, subscribe if you haven't already, and seriously consider sponsoring the channel. We don't have corporate backing. We don't have advertisers pulling strings. We have you, and that's exactly how we want it. Your support keeps us independent, keeps us digging, keeps us honest. Thank you for being here, and I'll see you in the next one. Before we go any further, I need to ask something from you, and I mean this sincerely. If you're finding value in what we do here, if you appreciate that we're not just regurgitating headlines, but actually digging into the facts, cross-referencing sources, spending hours making sure what you hear is accurate and not just another piece of clickbait nonsense, then please hit that like button and subscribe. It costs you nothing, but it tells YouTube that this kind of journalism, this kind of honest, independent reporting matters. And here's the thing. We work incredibly hard to avoid fake news. We fact-check relentlessly. We verify. We don't just copy and paste from wire services or parrot what everyone else is saying. That takes time, effort, resources, and we do it because you deserve better than the garbage that floods the internet every single day. So if this channel has given you clarity, insight, or just helped you understand what's really going on in the world, consider sponsoring us. Seriously, your support keeps us independent. It keeps us free from corporate influence, free from agenda-driven narratives. It's just us and you, and that's exactly how it should be. Thank you for being here.